Why I love John Bogle, and you should too, my friends. You see this right here? This is John Bogle's investment return formula. You got return equals your dividend at the start of the time period, plus the earnings growth over the time period, plus the change in price to earnings ratio over the time period. It's incredibly simple, fundamental. You've got to know this because once you get how this works, you won't be suckered by all these other shenanigans out there. I'm just telling you right now. I'm going to read you this. This is going to be a long, maybe a long, I don't know, but it's an article that Bogle had written in the Journal for Portfolio Management in 2015. I've just been wanting to do this for a long time. And finally, I'm going to do it. I don't care. So we're going to go through this. We're going to go through this. I mean, it's just, I don't know, what, 8, 9, 10 pages of stuff that's wonderful. I do think this is probably going to be the most important YouTube video that you will see today, for sure, when it comes to investing, because it's incredibly, incredibly illuminative, informative, and simplicity. And the simplicity, too. That's what makes Bogle so great. John Bogle, American hero. All right. So here we're going to start with a couple things. On the state of long-term expectations, Keynes had also described the value of simplicity. There, Keynes warned, it is dangerous to apply to the future inductive arguments based on past experience, unless we can distinguish the broad reasons for what the past was. Keynes' solution was Occam-like. We must consider the source of stock returns. He enumerated just two sources, enterprise and speculation. Enterprise refers to the actual business results of corporations, the stuff of which the dividend discount models are made. For Keynes, enterprise involved forecasting the prospective yield of assets over their entire life. Speculation, on the other hand, involved forecasting the psychology of the market, the ephemeral emotional response of investors seeking to anticipate how other investors will react to particular events. In his thesis, Bogle cited those very words. He also noted that Keynes' concern was that the conventional evaluations of stocks, which is established by the mass psychology of a large number of ignorant individuals, is liable to change violently as a result of sudden fluctuation of opinion due to factors which do not really matter to the prospective yield. I hope you're getting where he's going with that. So Keynes is saying speculation, there's no way to validate speculation. It's literally the delusion of the mass amount of people. There's a guy named Harry Mackay, The Madness of Crowds. All right, he wrote a book, 1700s, The Madness of Crowds, with the Dutch tulip the bubble and whatnot. I just want to read this again. Bogle, conventional valuation of stocks is established by the mass psychology of a large number of ignorant individuals and is liable to change violently as a result of sudden fluctuation of opinion due to factors which do not really matter much to the respective yield. Oh, man. To combat the developing influence of speculation in the stock market, Keynes argued for a substantial government tax on all transactions. Disagreeing, though, Bogle argued that a growing mutual fund industry would come to alleviate the problem by supplying the market with a demand for securities that is steady, sophisticated, enlightened, and analytical, a demand that is based essentially on the performance of a corporation, i.e. its intrinsic value, rather than the public appraisal of a sale of the share that is the price. Time would soon prove that Keynes got it right and Bogle got it wrong. Although the transaction tax concept has not yet become reality, mutual fund managers have largely become active traders with a short-term horizon rather than sophisticated long-term investors focused on enterprise. But this distinction between speculation and enterprise remained on Bogle's agenda right up to the time he wrote his first article in the Journal for Portfolio Management in 1991. Quantifying the sources of stock returns. Keynes made no attempt to quantify the distinction between enterprise and speculation. Remember, two sources of stock returns: the enterprise, the business growing year over year, and speculation, the change in the public's valuation, their own. Do I like it or do I not like it? That's it. Keynes made no attempt to distinguish between the two, but Bogle did. He expressed the distinction in simple terms that Bogle postulated could establish in advance reasonable expectations for the decade-long return on stocks. Enterprise, which Bogle redefined as investment return or fundamental return, would consist of the dividend yield at the start of the period, plus the annual rate of earnings growth that followed. Dividend yield at the start of the period plus the annual rate of what would follow. Hold on a second, let me get rid of that. The growth year over year. Speculation, which he modified to be speculative return, would consist of the annual percentage rate of expansion or contraction. That's a change. That's supposed to be a triangle. The change in the price to earnings multiple during the period. And that's his formula right here. Investment returns represent the intrinsic value the corporation's business creates. It has steadily risen ever since the availability of historical data, now more than 125 years. So let me just write this down because this is important. Investment return from the business model, speculative return. Essentially a gamble. Speculation is a gamble. That's what it is. All right, so let's keep going. All right, since 1871, investment return has grown at a nominal rate of 8.6%. And then speculative return, on the other hand, has no such stability, nor does it demonstrate any long-term upward bias. As optimism fades, pessimism flourishes, and vice versa. So the influence of speculation on stock returns resembles a sine wave. And if you all know your electricity, it goes like this. All right, so we got sine wave. It goes up and down, but no bias upwards. Sometimes it's up, sometimes it's down. And what Bogle says always reverts to the mean. Accordingly, the PE ratio soars and then tumbles over and over and over again, producing but a tiny positive addition to stock returns on balance over the century. And I'm going to show you here. See this? The blue is the investment returns. We see we had some negative investment returns there because we got earnings getting crushed. And here is a speculative returns. All right, so we got exponential growth in investment returns and basically a reversion to the mean, just a tiny little bit over the course of since 1871. Yeah, 1871 is speculation. As it happens, during the past 100 years, the PE ratio rose erratically from 14 at year end of 1914 to 20 at year end of 2014. As a result, the annual rate of speculative return came to just 0.4%. So here we got 0.4%, and here we got, what, 8.6. So again, if you're looking for investing and you're looking for a long term, which it should be, because if you're looking for a short term, you're a speculator, you would say you need to focus solely on the investment return, the intrinsic value. All right. We conclude that in the long run, the average total return of 9% earned on stocks during the past century has been substantially about the economics of the business and not the emotions of the speculators. As Benjamin Graham wisely put it, the stock market is a weighing machine in the long run, but it's a voting machine in the short run. And again, this is from Bogle. I don't know, did I even introduce this article yet? Occam's razor, establishing reasonable expectations for financial market returns. In fact, what we'll see here, you can see this. This is the reversion to the mean. So sometimes this is right down here. This actually, let me read. I'll show you this in a second. Now, Bogle wrote this in 1991. Now, some 25 years have now passed since January of 1990, the inception date of Bogle's first study, where he came up with this model. We now have 15 moving 10-year periods during which to appraise whether our sources of return have been effective. This period began by a great bull market up 455% from 1989 to the mid-2000, followed by two bear markets of roughly negative 50%, 2000 through 2002, and then again 2007 through 2009. Interspersed with two more than commensurate recoveries, ending up with a 25% of 25-year return of 894% in total, or 9.6 annually. Surely it'd be easy to make the case that such volatility was characteristic of past stock market history and would be likely characteristic of future market fluctuations. However, as we shall later note, future returns on stocks are likely to be significantly lower than the past century. In total, the Bogle model suggested that during this quarter century, the last 25 years, from 1990 to 2015, reasonable expectations for annual stock market return would come to about 9.2%, given this right here. In fact, the total return on the S&P 500 came to 9.6, so it's basically spot on. Almost identical. Although we find this validation of the model gratifying, we suspect a fit this close to the actual return data has more to do with luck. Reaching this virtual identity in total returns for the full period, however, can come with a series of significant variations. And this is what I'm talking about. So they're basically saying we're going to get 9.2% if we look at the earnings model, dividends plus growth, because Bogle doesn't assume any upward speculation at all. He's just saying dividends plus growth. And so he's saying this is what we're going to get. Now, on any given year, when the markets are falling off a cliff or when the markets are up, you're going to have a difference, significant variation of the average, the mean here, if you will. All right, so this is Bogle saying 9.2, and we have all these very short-term entities here, but at the end of the day, the average short-term entities gave us 9.6. So basically, Bogle was spot on for this side, the intrinsic value of the investment, and the change in P to E ratio is 0.4% again. So that's the difference between 9.2 and 9.6. It's actually fundamentally, it's illuminating if nothing else. Not that the model started off well, quite the reverse. Ironically, the larger gap between the expected return of the Bogle model and the actual return of the S&P 500 occurred during the very first decade following the publication of Bogle's initial article in 1990. In Bogle's conclusion, he noted that stocks, and this is going into, he did this 1990, talk about the next 10 years. Bogle noted that stocks will have their work cut out for themselves to exceed returns in the 8 to 12% range in the 1990s, perhaps averaging 10% annually, and of course is much higher than that. Bogle, you idiot! Oh, how did you not know that? But he was cautious about his projection, noting that we could have unusually high optimistic sentiment that results in a higher price-earnings ratio. Indeed, why not? This is literally a quote from Bogle in 1990. And earnings growth a decade higher than any of the prior decade. Again, why not? Those two events came to pass. With the decade ended in 1999, the annual return on stocks totaled 18.2%. So while Bogle was spot on here for the decade of 1990s, he was wrong here. Significant increase in PE, change in price to earnings ratio, as we can see by a PE ratio of, I think it was like 31.6 at the end of the decade. As a system, the Bogle model worked almost to perfection. That is, the model can be used effectively to decompose actual returns during the 90s. Adding the dividend yield of 3.2% at the beginning of the decade, 3.2% at the beginning, plus actual earnings growth of 7.7, so 3.2 plus 7.7, let's see, the investment return came to 10.9%. So between this and that, we had a 10.9% investment return over the decade of 1990s. But the PE ratio soared to a record near 31.6 at the end of 1990, a level then without precedent in stock market history. And the speculative return totals 6.9% a year. So there's no way someone could predict that because it's pure speculation, it's pure luck. The actual annual return of the S&P 500 was 18.2%. Although the Bogle system worked almost perfectly, his expectations for total returns during the 1990s was a total flop. His projection of investment return proved right on the mark with a 3.2% dividend yield plus earnings growth of 7%. But he had expected a negative right here to drop by 0.8% when in fact it was up, 7%. So he was wrong here big time, but he was right here. All right, but that's not to worry because what do we see? So here, this is the model, a reversion to the mean and stock returns. And so what we see here, 1990, you see the market just flying up and up and up. So here's Bogle's model, and here's the actual S&P 500 returns. What do we see? But he was spot on to about 1995, and that's when Greenspan talked about irrational exuberance. And then the market took off like a bat out of hell. The PE ratios just jumped like a crazy man. But then what happened in 2000? Kaboom. And what we have here, again, almost identical to Bogle's model. It's crazy. Yes, sometimes what will happen in the stock market is obvious, but predicting exactly when it will happen is a fool's game. The behavior of investors, and especially speculators, over the short term is impossible to predict. Could not agree more. In all, it seems fair to conclude that the establishment of rational expectations for subsequent decade-long returns on common stocks with the Bogle model has been effective. Its principal flaw has been manifested during these periodic occasions when the investor behavior is highly erratic, huge changes in PE ratio. But while such variations can magnify the inevitable volatility of short-term stock returns, PEs have over time inevitably reverted towards the long-term mean. Yep, 100%. In fact, PE ratios are not wholly unpredictable. Our data show that over the past century, when the multiple at the start of a given decade was 20 or more, it was lower at the decade's end 70% of the time. If the multiple was 12 or less, it was higher at the decade end over 85% of the time. So what we're seeing here, if you have a high PE to start the decade, you're probably going to have a lower PE to end the decade. If you have a low PE to start the decade, you're probably going to have a high PE to end the decade. So you can kind of factor in this part of this the speculative side of the Bogle model to give you like in Bogle did 1990, a negative 0.8%. When it actually turned out to be 6.9. Not all the time. There's no 100% correlation there, but it's close enough to say the PE ratio is pretty high. I'm going to look at this on a little bit on the negative, which would reduce my earnings my stock return anticipation. Despite the strong empirical evidence for its effectiveness, academics haven't taken kind too much to the Bogle model. One important supporter, though, is Burton Malkiel, who wrote A Random Walk Down Wall Street. And he says, very long returns from common stocks are driven by two critical factors, the dividend yield at the time of purchase. The dividend yield at the time of purchase. Who's harking on that recently? Your old buddy Josh. And the future growth rate of earnings and dividends. So the dividend yield at the time of purchase plus the future growth rate plus the growth of dividends in the future. I mean, literally, that's what it comes down to. Which can be shown to produce a very simple formula for the long-run total return for either an individual stock or the market as a whole. The dividend yield for the market as a whole on January 1926 was 5%. The long-run growth rate of earnings and dividends was 5% as well. Thus, you got an actual rate of return nominal of 10%, which is exactly what happened. Over shorter periods, such as a year or even several, a third factor is critical in determining returns. This factor is a change in valuation. This is Malkiel. Did he win a Nobel? I don't think he did, but he's from Princeton. Maybe he did. Random Walk Down Wall Street. I can't remember. But anyway, either way. All right. Now we're going to talk about bonds. And this is what I'm telling you right now. This is where it's so easy to predict. And again, this is from Bogle, not from me. But although we consider the Bogle model of simplicity in establishing realistic expectations for future stock returns, it pales in comparison to the simplicity of the Bogle model for bonds. There is but a single dominant source of decade-long returns on bonds, the interest coupon. I mean, I've said this so many times, I'm going to keep saying it. The interest coupon is you're going to be returned. There's just no other way around that. The historical record confirms that the entry-level bond yield is an excellent proxy for their subsequent decade-long returns. For example, the 10-year return on the 10-year Treasury has been almost wholly determined by the initial yield to maturity, and indeed, it is difficult to imagine a tighter fit. And they're just showing you this is going to be the 10-year yield when you buy it, and that's the total return. The correlation is so high. It's 95% correlation. So if you're looking at bonds, what are you currently getting? That's going to be returned unless it goes bankrupt. There's just no other way around that. Let's see. Bogle wrote that the fact of the matter is there is a number worth knowing to establish reasonable expectations for future returns on bonds, and that is the initial interest rate. In fact, Malkiel said long-run returns from bonds are easier to calculate than those from stocks. Over the long run, the yield that a bond investor receives is approximated by the yield to maturity of the bond at the time it's purchased. I'm just telling you, you say your bond, what am I getting? I'm getting 3%, that's what you're going to get. It's literally that simple. No reason to think any more about that. I'm getting 5%, that's what you're going to get. No reason to think anything more. In that article that Bogle talked about in 1990, Bogle emphasized that looking at past bond returns had misled bond investors. Following 4 consecutive decades, the 30s through the 60s, in which nominal return on the long-term Treasury bond averaged 1.9, he explained that bonds became known as certificates of confiscation. But Bogle argued that past returns on bonds are utterly devoid of meaning. Past returns on bonds are utterly devoid of meaning. There is almost no lesson of history that is relevant except the wrong lesson. Never buy bonds. He's not saying that. He's just saying the past returns are irrelevant. As the 90s began, Bogle noted that the yield on the long treasury was 8.1%, which is more than 4 times the average yield during the 4 decades earlier. All right, so they're getting 8.1. Before it's 2. With his initial expectation that stock returns would be around 10% range over the coming decade, Bogle argued that U.S. Treasury bonds with substantially lower risk to principal should provide competitive returns to stocks. Whatever the case, he expected an annual return of 9% on long U.S. Treasury bonds during the 90s, and the actual return came to be at 8.6. So if I'm getting 8.6 on long bond with no risk, and I'm shooting for 10% on stocks, which I could lose everything, it's going to be hard to overlook bonds for sure. What's ahead for, and here we go, the correlation between 10-year Treasury yield and the returns. I mean, you see that. I mean, the correlation is, you can see that right there, 95%. 95%. All right. All right, so what's ahead for stocks? Given the Bogle model's solid results in establishing realistic expectations for decade-long stock and bond returns, it seems almost obligatory for us to consider the return possibilities over the coming decade. The dividend yields on stocks as of this writing, 2015, was 2.1, which was less than 1/2 the long-term norm of 4.5. Although historical nominal earnings growth has averaged 4.7% a year, investors have enjoyed earnings growth of 6.2% per year over the past quarter. Let's see. Thus, a prospective nominal... but they're expecting earnings growth seem likely to increase around 5% is what the Bogle model is predicting. Thus, the prospective nominal investment return on stock seems likely to run in the 7% range. 5% earnings growth, 2% dividend yield, well below the long run average, about 9%. Nonetheless, it seems reasonable to expect that the historical upward slope of stock returns will continue, although likely at a lower rate than in the past. As for speculative return, the mystery of investor behavior remains. The market's PE multiple in 2015 was 20. Past reported compared to the historical norm of 17.8. So in 2015, the market's nominal was 20, which is about 20%, 10% higher than historical. So they're expecting, and so what they're expecting is because the PE ratio is high, we expect that to drop a little bit. So a 7%, we got 2 plus 5 minus 1. So Bogle's expecting a 6% rate of return on stocks. The current outlook for bonds is far below the historical norm of 5%. The 10-year Treasury as of this writing was 2.4, and so they're giving it basically a 2.5% return. Combining the two, 3% for bonds, because then you got to look at, they're going to round up to 3%, and 6% for stocks. They're getting about a 4.5% nominal rate of return on stocks and bonds on a 50-50 portfolio. Then he goes into the fees that investors pay. I'm not going to get into that here, but it's incredible. Maybe I'll do that part 2. Caution, few investors capture or exceed the market returns. But anyway, we'll just conclude that we'll do a part 2 of this. Combining our essential expectations for stocks, nominal annual returns the coming decade at 6% and around 3% for bonds, we would expect an investment portfolio of 50% stocks and 50% bonds to give us about a 4.5% rate of return over the coming decade, compared to an annual return of 8% over the past 100 years. All right. Such a return would represent a substantial shortfall that could well shock investors who have earned those generous returns during the past quarter century, as well as investors who have put too much faith in market history. All right, so I'm going to do part 2 of this when I come back from the doc. Now I'm going to go see the doc, get my MRI looked at, see what he says if I need surgery. So I'm telling you, remember this. Dividends, we can quantify that. Earnings growth, we can quantify that. It could be kind of shenanigans, sure, but at the end of the day, you got to use what you got to do. Trailing 12 months, or you actually look at the forward months. So you got dividends at the day you buy it and earnings growth. You look at those two numbers, you combine them. Here's the speculative part, the price. I'm willing to pay 30 price to earnings ratio. Not me, I'm only willing to pay 10. You can't predict that. So you can't predict that. You shouldn't use it. You just say, I don't know what this is going to be, so I'm going to avoid that. But I do know what this will be. So, and if you look historically, this has been the dominant return of the market. This has been small anyway. So you just go with this, and I'll give you your stock return over the next 15, 20 years for sure. Nominal, without inflation. Bonds are even easier. Bond pays 3%, you're getting 3%. There's just no other way around that. All right, stick tuned for the next one. I'll see you next time.